Options are a type of derivative security. Warren Buffett once referred to derivatives as financial weapons of mass destruction.
The usage of them on an expanding basis, more and more imaginative ways of using them, introduces essentially more and more leverage into the system.
So, what are options? How can you utilize options to profit in your portfolio? And should you consider using options in your investing strategy? Tune in and find out. So, options contracts are essentially taking a bet that a stock will go up or down. They're cheaper than buying the underlying stock. So if we have like a $10 stock, 100 shares is going to cost you $1,000. That same stock, an option will probably cost $1. So $1 times 100 shares, that's $100. So it's 10% the ultimate cost. Now, these typically exist for liquid stocks, meaning stocks that have a solid trading volume. That means that many shares trade per day, typically in the hundreds of thousands, if not millions. Now, the writers of options are going to be investment banks. They use options to hedge their own positions. Hedge means to neutralize a position from volatility.
Volatility does not measure risk. The problem is that the people taught about risk do not know how to measure risk. And the nice thing about beta, which is a measure of volatility, is that it's nice and mathematical and wrong.
So obviously, to understand options, we need to go through a bunch of different terms. A call option is the right, but not the obligation, to buy a stock at a particular strike price. A put option is the right, but not the obligation to sell a stock at a particular strike price. The strike price is the stock price at which you can exercise an option. Now, the premium is the cost of the option. Options are sold in lots of 100. You cannot buy an option on one share. Each contract is for 100 shares. Now, in terms of profitability, out of the money means that the strike price is significantly above the current price on a call or below the current price on a put. Out of the money options are going to be cheaper. At the money means the strike price is at the current trading price of the stock. And then lastly, in the money, the strike price is below the current stock price on a call option or above the current stock price on a put option. Now, these are going to be more expensive because they're already in the money, meaning they already have profit associated with them. Naked options, this is where you do not own the underlying stock. The expiration date is the date at which the option expires. So the closer the time to expiration, the less the option is going to be worth. If you have more time, you have more optionality, pun intended. There's American options and European options. American can be exercised at any time up to the expiration date. European can only be exercised on the expiration date. So the exact same terms, an American option would be worth more or more valuable than a European option. If you're enjoying this video, please smash that like button. All right, so let's take a look at an example of a call option. Remember, this is a bet that the stock price is going to go up. So in this particular case, the strike price is $5. That's the price that you can buy the stock. The premium, or the cost of the option, is $1. So we're going to be losing money from $0 to $6. $6 is going to be the break-even point. Now you're like, wait a sec, Ken, I thought you said I could buy the stock for $5. Well, 6 minus 5 is 1, and it cost us $1 to get into this particular option. So that's the break-even point, 0 at 6. The good news is, after that, it's pure profit. We're in the money. Now, the one thing to remember is call options, the max profit is unlimited because hypothetically the stock could go to infinity. The max loss is going to be the premium, or $1. Now, you can exit the call option by selling it to somebody else once it's in the money, or you could choose to actually exercise the option. Either way is completely fine, and it's totally up to you. Now, I'm going to share with you later on in this video how I profited tremendously by utilizing call options, so stay tuned. Next, we have a put option. That is a bet that the stock price is going to go down. So in this example, we have a strike price of $6. That's the price that you can sell the stock. The premium, or the cost of the option, is $1. So that means we're losing money from $10 through $5. The break-even point is $5. You could sell something for $6, but it's trading at $5. You profit $1, but it cost us $1. So anywhere below $5, that's when we're in the money. That's when we're profiting. Now, unlike a call option, which has maximum or unlimited profitability, the put option has a limit. The stock can only go to 0. So the max profit in this particular example, $5. Now, the max loss, just like in the call option example, is $1. The most that we can lose is our premium. Okay, so 2 times where I profited utilizing options and what you should do. So I used call options during COVID when energy companies were tanking since nobody was driving. I bought very long-dated, out-of-the-money options, and I knew when things got back to normal, I'd profit very nicely. That's exactly what happened. It was about 2 years later. They were very much in the money. I think I made like 3 to 4 times my money on those. So I was very, very happy with that investment. Also, put options. So put options I actually used very recently with the most recent GameStop meme stock craze. What happened was the stock was trading at like $50, $60 a share. I bought put options at a strike of 50. And then what ended up happening was the stock closed in the low 20s and I exercised those options. So what ended up happening was I was able to profit 32% in only 3 days. Now, some things to remember here. The further the expiration date is, the more expensive the option. Why? You're paying for time. Some warnings. Unlike holding the stock, options do not pay dividends. You can lose your entire investment, and you will lose your entire investment if the option expires outside of the money. Now, some of my thoughts. I typically do not recommend investing in options. The main reason is there needs to be a catalyst.
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule. And that's all the rules there are.
Yikes. So buying options is going to be more akin to gambling than investing. You're either going to make money or you're going to lose everything. So what should you do? I am not a financial advisor. I know nothing about you. This is education and not investing advice. But I would much rather buy shares in great companies that are going to compound and build wealth over many years. If you decide to buy options, please make sure that there's some sort of catalyst, meaning there's something that's going to happen to the stock. There's a lawsuit, there's earnings beat or earnings miss, new product that's coming out, something that's not really anticipated by the market. And that's going to be the way that you're going to profit. If you want to learn about how options were used in the GameStop AMC meme stock craze, check out this video right here. Please share this video with someone who you think would find this helpful. And as always, be relentless.